All right, let's dive into Nano Dimension today. Their latest earnings report just dropped, and honestly, the big story isn't just the numbers, it's the strategy. They're calling this a portfolio reset, which is basically code for a major shakeup. We're going to get into what that really means.
So you look at the headline number and you think, wow, revenue shot up over 72% from last year. That sounds incredible, right? You'd expect the stock to take off, but it didn't. By the time the markets closed the next day, the stock was actually down almost 5%. So what in the world is going on? That contradiction, that's the whole story, and we're about to unpack why the market wasn't exactly cheering.
Okay, here's where it gets really interesting. That huge 72% jump? It pretty much all came from one thing, their recent acquisition of Markforged. That added about $16 million to the top line. But if you peel that away, if you look at Nano Dimension's original business, things look, well, not so great. Their core revenue actually dropped by a staggering 35%, and that is the weakness that Wall Street really noticed.
And if we look at the rest of the financial snapshot, the picture gets even clearer. Yeah, the revenue number was big thanks to the acquisition, but their adjusted EBITDA loss, that actually got bigger, widening to almost $17 million. So they're bringing in more cash, but they're also burning more cash to get it. Now, there's one undeniable bright spot here, and it's a big one, their balance sheet. They are sitting on over $500 million in cash and investments. That's a massive war chest that gives them a ton of flexibility.
So, who's steering the ship through all this? That would be the brand new CEO, David Stehlin, who just took over last week. He's got a deep background in tech and M&A, and his message on the earnings call was totally clear. It's all about execution and being transparent. You can really feel from this quote that he's signaling a major shift, a new, way more focused approach is coming.
And here is that new approach, laid out in a 4-step playbook. First, they've got to make the Markforged integration work and find those synergies. Second, and this one is absolutely crucial, they're putting a wall around the failed Desktop Metal acquisition. Third, they're kicking off a big strategic review to figure out the best way to create value for shareholders. And fourth, the foundation for all of it is a new focus on being smart with their money and getting margins up. Let's drill down on that second point, because the Desktop Metal cleanup is a huge deal. They took a massive $139 million write-down and officially moved it to discontinued operations. What that means for investors is that they're basically taking this financial anchor off the main books. It removes a huge distraction and makes the company's financial story a whole lot clearer going forward. It's a classic case of addition by subtraction. So how did the market react to all this? Well, it was a bit of a ride. Right after the call, the stock ticked up a little bit in after hours. It seemed like investors heard the new plan and were cautiously optimistic. But that feeling didn't last. By the close of the next day, the stock was down almost 5%. The market is sending a really clear message here. The new plan sounds good, but we're going to need to see some proof before we buy in. Which of course brings us to the big question. Is this a stock you should be buying? Well, the case for it, the bull case, is pretty compelling. You've got a new focused CEO, a forecast of a balance sheet with all that cash, and a much cleaner story now that Desktop Metal is walled off. But the bear case is just as strong. The core business is shrinking, fast. They're still burning through cash, and this whole turnaround depends on execution, which is never, ever a sure thing. So that brings us to our final verdict here on the next call. We are initiating coverage with a market perform rating. Look, the new strategy is exactly what this company needed to do, and that huge balance sheet gives them a ton of safety. But you just can't ignore a 35% decline in the core business. That is a serious red flag. This is what we call a classic show-me story. Until we see real proof that they've stopped the bleeding in their legacy business and are getting real value out of the Markforged deal, the risks and rewards just feel pretty balanced to us. And as always, just a reminder, this is not financial advice. Make sure you do your own research before making any investment decisions.